The US dollar has been on an absolute tear this year, with a run of stronger than expected payrolls reports combining with inflation that sits well above target to fuel speculation that the Fed may be about to embark on a fresh tightening cycle. Traders certainly think so, with the Fed funds futures curve now pricing 42 basis points of hikes over the next 12 months. A quarter point move in September is heavily favoured, with another 25 basis point increase expected to follow. That's a remarkable turnaround from early March, when markets are pricing around 2.5 rate cuts from the Federal Reserve this year alone. That dramatic repricing has been one of the key drivers behind the US dollar's rally to fresh 2026 highs, as seen on the DXY chart. But before tomorrow's payrolls report, here's something worth thinking about. Not every US labour market indicator is telling the same hawkish story as payrolls. Earlier this week, the Conference Board's Consumer Confidence Survey showed the labour market differential, the gap between consumers saying that jobs are plentiful and those saying they're hard to get, fell to 2.4, the lowest reading in more than 5 years. So why does that matter? Historically, it's shown a very strong inverse relationship with the US unemployment rate. Looking at the chart, you can see that as the labour market differential has weakened, unemployment has typically moved higher. Now, that's no guarantee it'll happen again. The pandemic created all sorts of distortions, and relationships that had held for decades haven't always behaved as they did before. But it's not the only indicator pointing to a softer labour market. The household survey, which is used to calculate the US unemployment rate, has looked considerably weaker than the establishment survey from which payrolls is derived for much of this year. There are also legitimate questions surrounding some other labour market indicators, including the JOLT survey, where far lower response rates have raised concerns about the reliability of the signal. Of course, none of that means payrolls are wrong, although given the mammoth downward revisions we've seen in recent years, their track record hasn't exactly inspired confidence. But it does suggest the labour market may not be quite as strong as headline job creation implies. If that is the case and the unemployment rate starts to edge higher in the months ahead, markets may be getting a little bit carried away with pricing a fresh tightening cycle from the Fed. And if those 42 basis points of hikes currently priced into the futures curve prove to be too optimistic, one of the key pillars underpinning the US dollar's rally this year could start to weaken. Best of luck with your trading. I'll catch you next time.